Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the show where you can have your property related questions answered by our team of property experts. And with me today are Michael Allison, Commercial Director of Roma Finance Limited. Welcome to you, Michael. And Chris Barry, Business Development Director, Thomas Legal, National Conveyancing Firm of the Year. Welcome to you.
Thank you very much.
Now, it's both your first time on Question Time, so we'll try and be gentle and take you through it. But we're going to start with you, Michael. With the government announcing 1 million new homes over the next 3 years, I wish, are developers reacting to this, and are you therefore seeing an upward trend of development loan applications?
I think it's an interesting point. Obviously, the 1 million homes is 1 million homes of different varieties and types. There's needs for good quality housing stock, new homes, social housing, etc. When it comes to increased demand for development finance, what we are seeing at the moment is a lot of repurposement of the traditional town high street. So probably taking properties that weren't previously for residential use and changing them into those mixed rent properties. So certainly we've seen a lot of that, because at the moment, with the uncertainty that developers are facing with regards to the finance, etc., and the exits of these loans, we're seeing that people are probably sticking to smaller projects at this moment in time.
I know here in Canary Wharf there are 2 or 3 developers that have actually got sort of 40, 50, even 70-storey schemes with planning and foundations done, but they've actually shelved them for 2 years because they say that they just can't risk starting and then have a sort of escalation of material costs halfway through. I mean, I don't know what you do at that point, because you've probably sold, your bank's probably made them sell a lot of them off plan at a fixed price, one thing or another. And if the costs rocket halfway up, you're stuffed, to put it technically, aren't you?
Well, definitely. I think it's that uncertainty that's probably making people steer away from the larger developments at this moment in time, which obviously we need the larger developments if we're going to hit that million quota. But people still want to be active within the marketplace. They still want to have their teams working.
But Michael, what I see is this. I mean, just looking at it as an outsider, you've got the government saying 1 million homes 3 years. Well, first of all, who do they mean we are going to build? I'm not quite sure who they mean. You did there to the fact that there are different sectors of the market, which is a point I often raise when somebody says about the property market. Well, which bit do you mean?
Yeah.
So that's it. But if we're to have 1 million new homes for residential purposes over the next 2 or 3 years, they have got to start now, haven't they? The average development cycle is probably 2.5 to 3 years from planning to fruition. So if you're not getting the applications in now for these bigger developments, we haven't got a prayer of hitting those numbers, have we?
No, it's all about joining the plans up. You know, we see changes in planning laws quite regularly. We've got the changes with regards to the buy-to-let landlords, the EPC ratings, the white paper that's out there. There seems to be a lot of noise around housing without a coherent end-to-end plan. It's certainly what we're seeing. So building 1 million homes is great. Is that 1 million rental homes? Is that 1 million first-time buyer homes? Is it 1 million social housing homes? And once we understand what that 1 million homes constructs of, what is the plan to get us there? Because at the moment, there's a lot of moving and changing parts within the development finance and in the property world. That means that people are moving from putting out one fire to another without the ability to plan for 2-3 years' time.
Yeah. Do you know, I've said for many years now that the simple answer to this stock shortage, property shortage, very simple. If a developer thinks he can sell his product and that means the purchaser being able to fund it, they'll build as many as you like. You don't have to do anything special. You don't have to have new government policies. You just need to make funding easy. I mean, when we had the, 100% sort of mortgages being blacklisted, as it were, in 2008, it wasn't our fault. There was no great, huge repossession numbers on 100% mortgages. It was the American market that caused that sort of trouble, wasn't it? So, I mean, I think the problem's relatively easy to solve, and I think if firms like yours are willing to put in place the finance for these projects, then I really don't see what the problem is, as long as the retail funding goes hand in hand with it.
Yeah.
And we're not talking about 25 and 30% deposits, which is pretty unachievable for a lot of people.
I think the incentive for developers, though, is diminishing tremendously, because land prices are going up, the end product potential value is coming down. materials are going up, so the margins are being squeezed. And
they are
what a
indeed.
developer was making 10 years ago is not what they're making today. And a development could take 2 years to go through the planning process and get to final units that are being sold off at potentially a loss. But if they're social housing, that doesn't really fall into that issue as much.
No, it doesn't. But again, if we get onto that subject, I'm not sure our current form of satisfying social housing needs is that clever. I'm not sure that having these housing associations sitting as a sort of intermediary between developers and councils, and I'm not sure it works terribly well. I'm not sure it's a layer that's really needed, is it? It's only come in to substitute the fact that councils aren't allowed to build and provide homes any longer, I think. I mean, when I was a kid, it was very simple. You either bought your own home or you lived on a council estate, one of the two. But
and of course, they have the power for a compulsory purchase order as well, so they can acquire the land at a reasonable price.
Yeah. Okay, all right. Thank you for that, Michael. Now, Chris, on to your first question. The industry seems to be blaming increased demands from lenders for additional information and security from borrowers in regard to increased conveyancing times. Although this is recently down from approximately 150 days for an average transaction, what can be done to speed things up? And I mean, I think this is something that comes up on the programme time and time again. Lawyers will say, well, it's the lenders. They want so much more information. It's taking us time to collate the information. Are they right?
I think that's a bit of a cop-out, if I'm honest.
So, come
yes,
on, let's hear it.
I'm glad he said that.
So there is mass variation between lenders. High street banks, I think, jump onto the back of this stuff quite quickly. So whether it's getting excited about Japanese knotweed or the Building Safety Act or doubling ground rent, the big banks are normally pretty quick to get their heads around it.
Yeah.
And the process with them from a legal perspective is a lot easier because they're likely to do things automated signatures, everything else, portals. With some of the more bespoke lenders, with some of the subprime lenders, it can be a nightmare. The difference in work.
Is that because they're nervous?
Yeah, I don't think they're big enough to take the risk either, potentially. I don't know. But the difference can be days, for sure. But it's such a small percentage of the overall time. I mean, 10 years ago, we were about 80 days on average. Now, as you quite rightly say, we're up to 150, or a bit short now at 135. Nothing to get, to celebrate about.
No.
But the major issues, I feel, are with the conveyancing firms themselves. So we have got the top 6 or 7 conveyancing firms by volume in the country operating on something like 40% of all chains. And the way the business model is set up is they are thinking that they have to charge the cheapest price to attract the work, and then to make the business model stack up, they have to take in more work without managing their work volume. So you can have members of staff, they're dealing with 200, 300, 400 matters, 200, 300, 400 clients at any one time, just isn't sustainable. So they're taking longer to turn things around. So yes, there are issues with timescales on mortgage lenders. There are issues, of course, as we know, with local authorities, with the land registry, but conveyancing firms themselves could be a lot more efficient, I think, as a mass.
Well, it's quite interesting. I was talking to a solicitor on a programme we did some time ago, and they were saying that under some of the national statistics now, a lot of firms of lawyers do not have a 100% focused conveyancer within the team. What happens is if somebody comes in and wants to buy a house, then because it's the family firm and all the rest of it, somebody will take that responsibility on. But it's become such a specialist sort of subject now. You really do need a full-time conveyancer rather than a solicitor that will just step in and do it.
Correct. There are about 25,000 conveyancers practicing. And the reason there are so many and so many doing such little volume is because they can't afford to close the doors. So if you shut up your conveyancing shop, you need to continue to pay PI for 6 years in case somebody comes back and claims. Well, if your PI is £100,000 a year, it's a lot of money to pay just to retire. So they're waiting to get bought, they're dabbling just to keep practicing. And if they go off to play golf on a Friday afternoon or they're on holiday for 2 weeks, the process does get slowed.
And of course, the client will say, well, look, I want you to look after my will. I want you to look after this, or we've got this bit of a problem here. So why won't you buy my house for me or sell my house for me, I suppose?
Yeah.
I suppose you're going to get that argument all the time. Aren't
Yeah,
you?
quite right. And I think what happens in these multi-service law firms is that they are tremendously profitable across private clients and family and commercial and corporate law, but they probably look at the conveyancing department and say we're charging the lowest fees across the firm, but carrying the highest risk because sadly a lot of conveyancing isn't done so well. There's quite a lot of lawsuits going on. PI providers are pulling out of the market. There's only about 3 or 4 to choose from now in conveyancing, and costs are going up tremendously. So I think they're looking at that thinking, why would we invest in technology and people into our conveyancing department when we could just put better people into our commercial and corporate departments?
I've got a question, but I think I'm going to ask Michael, not you, because I'm going to say, Michael, do you think a lot of the bigger agents should have conveyancers in-house? Would that help?
Yeah, it certainly. I think you've hit the nail on the head.
I'm purposely not asking Chris.
No, I think you've hit the nail on the head when we say about, the borrower in our term will use their lawyer, and their lawyer will generally they'll be the jack of all trades for them. And what you find is certainly in development finance and bridging finance, if something comes across that they're not sure of, it gets moved across the desk, and then it becomes a waiting game, and that's where the black hole comes from. I think having specialist conveyancers in-house, agents, whoever that may be, estate agents, even lenders, having people within the lending organisation who truly understand conveyancing and can unblock those black holes is key for everybody.
Okay, that's great. Thank you both very much. That's all we've got time for in this half of the show. So join me again after the break when we'll be asking Chris and Michael more of your questions. Hello. Welcome back to part 2 of Property Question Time. I'm Stephen Galpin and I'm joined by Michael Allison and Chris Barry. Welcome back, guys. Michael, your second question. With hugely increased material costs, labour shortages and increased interest costs, is there a reluctance from banks to lend on speculative property developments? Now, just before you answer, I tell you what I think about that is that, I've worked sort of with a couple of developers down here, and I've been the subject of being harangued by sort of various credit committees and some of the banks looking out of the window here. The banks can make it very difficult, can't they? They can make conditions. A typical one is they say, well, you've got to sell 20% of the development off plan and then we'll look at it. So you go to Hong Kong or somewhere and you sell 20% of the development and you come back and the bank says, the trouble is they're non-UK nationals, so we can't really sue them if they don't go ahead. So can't you find an institution or something that's going to take 2 or 3 floors? So you do, and they want a bit of a discount. So you give them a discount, and you come back to the bank, and the bank say, you've done that, but price wasn't very good, was it? So you're sort of between a rock and a hard place all the time as a developer. It's very difficult to judge what the banks want.
It is. I think the key word in the question that you asked me was speculative. I think what everybody's trying to do is make an informed decision. If anything, if the last 4 or 5 years have told us anything, and the situation we're in at this moment, is things can change very, very quickly. You mentioned material costs in your question, for instance. Material costs are actually slightly coming down at the moment to the end user because they were stockpiled for the boom period. And as you said earlier on in the programme, people are perhaps taking a pause at this moment in time. And that then means that there's better quality labour available to perhaps the smaller developers. I think when it comes to the banks, everybody's got their own lending methodology. I do think that there is space for the specialist lender to step in at times, but it depends on the size of the scheme. Certainly a block of apartments in Canary Wharf, it sort of steps outside of most specialist lenders, I would say.
Well, some of these big blocks here, you're talking between £500 and £750 million sort of GDV, aren't you? So, the consequences of getting the pricing wrong are just horrendous, aren't they?
Well, I think if you get the pricing wrong on one block, you've got contagion within the area.
Yes.
Then contagion within the area goes widespread. I think that's the bit that everybody is nervous about. Certainly a lender knowing their market, working with a borrower or a developer who are buying well to sell well. If it's priced well, it'll still sell well. Who are able to procure materials and be savvy. And actually at this moment in time, people stepping back from the larger schemes but keeping the industry going with some of these smaller schemes and town centre regenerations. Certainly, I think people are taking advantage of that in the short period, but we've got to be really careful. Again, in the last 5 years, a lot of change has happened. We've seen spikes and drops and spikes and drops. Where we are in this situation at this moment in time may not be the same in 18 months.
I know you talk about the change of use on, say, high streets in particular, from perhaps commercial to residential. I mean, I think back, and I've had trouble in the past where you're looking at developing a block, you've got shops underneath, and a lot of lenders say, no, don't want shops underneath, I'm not going to lend there, I'm not going to do it. Has that view changed? Have people lightened up on that sort of thing now? Are they accepting a more sort of flexible view towards planning and use?
I think that, again, there's a nice spread of lenders now for borrowers. Perhaps in the past it was high street only, and high street would have their own, again, lending criteria, not next to a shop, not above a shop, or some people would be comfortable with that. But borrowers have more options now, certainly in the buy-to-let world. And in the refinance world, of specialist lenders have really come to the fore, whose appetite perhaps is more about the individual, more about the asset that they're lending on, rather than the surrounding area.
Well, I think I quite like that. I mean, it's probably because I'm getting old now, and I think back to those days. And at one time, the only time you would ever borrow money for a house from your bank was if you were in business. And the bank wanted it as security, so they would tend to tie the whole thing up. And you had your money from specialist building societies. And actually, to my mind, it wouldn't be such a bad thing if we went back to that kind of ethos. And I think with you talking about specialist lenders, I think it's sort of heading that way, one way or another. So slightly different clothes, but heading back that way. And I think that's a good thing. I like, for instance, in the buy-to-let market, you've got buy-to-let lenders. They understand the market inside out and are prepared to lend on the basis of a good business plan, rather than what are your current earnings, what are your current savings, what, this, that, and the other. They look at the business, and that's good news, isn't it?
Yeah, it's all about understanding the borrower in the story.
Yeah.
I think once you understand the borrower in the story, the asset actually becomes the third thing that you should be looking at. It's really understanding what that person is looking to do and having the time to investigate that. We live in a digital world, and we're moving further and further into that digital world. But what specialist lending brings, it brings the human touch, is the intelligent touch to decision making. Yes. And getting the story, sometimes it's the emotion that sits behind for the applicant.
It's actually coming away from the American system of points or tick boxes, isn't it? Which is a good thing, because we went through that silly stage at one stage of just, if you tick the right boxes, you got your money. If you didn't tick the boxes, you didn't get it. Missing the human element, as you call it.
It's a human element links to appetite. Appetite links to business. It's about learning from the ones that's gone wrong. It's about learning from the ones that's gone right and listening to the individual. And I think that's the art of lending, really.
Yeah.
I think the big difference to the landscape, though, is 20 years ago, you would go to your bank, wouldn't you?
Correct. Yeah.
And I think the vast majority of people did that rather than go to a broker. Now, I think the advice to any client is make sure you've got a broker who specialises in what you're trying to do. And
good broker relationships, excellent.
Good broker, good business.
Yes. Okay. Now then, Chris, I'm not suggesting we turn you into a robot, but do the panel think that with the digitalisation of information and AI, the industry is leaning towards using specialist-only conveyancing firms, possibly encouraged by the lenders too?
Yeah, I mean, absolutely, 100%.
That's a yes, is it?
The answer is yes. I think specialist conveyancing firms who are good at what they do and can reinvest their profits back into technology is only going to snowball, because ultimately what they're going to do is reduce the amount of administration involved in the process for both their staff and their clients. So the process becomes a lot quicker. I think AI is a really, really interesting one, clearly still very new to the industry, but there are some incredible prop tech firms out there now doing some really amazing things. And whether it's ID, AML, open banking, automating mortgage reports, reviewing leases, reporting, all these different types of things that are happening and developing day by day, is just going to really help the process. I'm very passionate about it, as you can probably tell.
Well, I think that's good. I mean, one of the things I've often thought is that, I've brought this up on the programme before, but I've never understood why land registry, for instance, doesn't become the central point for all these searches, whether it's Environment Agency, planning, whatever else, funded, if you like, by a subscription from conveyancing firms. It could be a central point of information. It would make your job so much easier just to press the button and say, I want a complete report on all the various aspects, you know, contaminated land, rivers, flooding, you know, onward and upward. I just think it would make life so much easier. And again, with digitalisation and AI, that could be so easy to do. And as you say, there are so many firms quite capable of doing that and organising.
Yeah, absolutely. There's some really, really good, promising independent prop tech firms that are doing similar and successfully doing it. I think the issue they then have is that there are about 4 or 5 big CRM firms that control the majority of estate agency firms, so they can integrate with them really easily. On the mortgage side, there are, again, some big players in the CRM space that allows integration, and I think that tackles most of the mortgage broker firms. But in the conveyancing world, there are hundreds of CRM systems that don't allow APIs, and that's where a lot of the blockers are. So the firms that I'm talking to are saying, well, we've tackled probably 3/4 of this, but if we can't integrate with lawyers, it doesn't really work. You need everybody bought in.
You do, don't you? That's why, again, I come back to what I was saying earlier. Is it a good idea to have conveyancers in the big agencies? I mean, I say the big agencies because they're probably the only ones that could sort of fund the process to start it off. You know, if it was one of the big agents, for them to take on half a dozen conveyancers would be neither here nor there. It'd be fine, be easy. But I do think we need to have change. I think we need to have change in the leasehold sort of act, which we're getting to some degree, but again, not quite enough really. I think, you know, I was joking with somebody the other day. I mean, I can't remember how many leases I used to see, you know, for a 60-story block that would say you must sweep your chimney every 3 months and keep the lawns mowed. You know, because they were just cut and pasted leases, and we've got better at that now. But I think it needs to get better still. We need leases for today, don't we? For today's environment. And I think the same with conveyancing. It's changed. We're in a different world. We need to be slick. We need to be fast. Hope you agree.
Completely agree.
Good. You?
Yeah, definitely. I think you hit the nail on the head, though. It all does start with land registry and comes back from there, because you can digitise everything you want. If they still insist on a wet signature on a document, you know, everything needs to be
6 to 9 months out of date with registration.
Correct. And then creating new titles.
Some instances.
Is it what?
24 months.
Yeah.
Delays, yeah.
Okay, well, that's all we've got time for today. So I'm going to say a big thank you to Michael Allison and Chris Barry for coming in today. Thank you so much.
Thank you.
Great content. Good to hear your answers. Thank you again. I'm Stephen Galpin. Join me again next time on Property Question Time.